So we had this revolving door. We would push people out or people would not stay, but we couldn't grow our occupancy. So it was like, time out. Let's change our strategy. Let's keep these folks who are paying rent, even if their rent is way below what we're achieving, and let's hit 95%. Cash flow is great.
Welcome to the Multifamily Wealth Podcast. I'm your host, Axel Ragnarsson, and on this show, I dissect how seasoned multifamily investors started, built, and scaled their businesses. What's going on, everybody? Welcome back to another episode here on the Multifamily Wealth Podcast. In this episode, I'm chatting with Moshe Crane of Sage Ventures, and Moshe is technically their head of branding and strategic initiatives, but he is someone who is heavily involved on the operational side of their business. Started at Sage in the leasing department and worked his way up and is now head of branding and strategic initiatives, as I mentioned, but he's still someone who is heavily involved in all aspects of operating their massive portfolio, which consists of over 4,000 units throughout the Mid-Atlantic, Sage being based in Maryland. And in this episode, we just dive into multifamily operations. And the way that Moshe and I got connected was just through LinkedIn, where he regularly posts about what he's seeing on the multifamily operations side of the house, different leasing tactics, different software they're using, different tips and tricks for multifamily investors. And I wanted to have him on to talk about how he views multifamily operations at this stage in the cycle, what they're prioritizing over at Sage, how investors can best lease their properties and renew tenants. And we really just have a holistic discussion around what's going on within the operational side of multifamily. So highly recommend you stick around and listen to this episode if you are an active operator of multifamily real estate, because I think you're going to take a few things away. Specifically, one that I really enjoyed in terms of a topic that we discussed was how you can think about the ROI of renewing a tenant at a lower rent than maybe what you could achieve if you were to take that property back out to market and spend money on renovations, which is not something that I think a lot of folks are discussing right now. And I mean, I talk about tenant retention ad nauseum nowadays, and it's been a topic of many different podcast episodes that I've released over the last few months, and it's just a large topic of discussion in the multifamily community in general. But Moshe has a really unique view on that part of the process because he's even more renewal friendly or renewal focused than even I am. And again, I think we've just been brainwashed over the last 4 or 5 years to always want to trade out leases because of the fact that there was a higher opportunity to push rents when somebody left an apartment and you renovated that apartment and then obviously placed a new resident. Whereas now it's not necessarily the case. And we have an interesting discussion around the financial components of making that decision, right? Or the financial ramifications of making that decision. So I think this is going to be a great episode for all the active multifamily operators and investors. And if you did enjoy this episode, please consider leaving the podcast a rating and review, as it helps the show get noticed by more folks. But enjoy this episode with Moshe Crane, and I'll see you guys in the next episode. What's going on, everybody? Welcome back to another episode here on the Multifamily Wealth Podcast. Joining me this week is Moshe Crane, who is somebody that I've connected with on LinkedIn for a while. I can't remember when I connected with you on LinkedIn, but I guess everybody connects with people on LinkedIn randomly over periods of time. And I've noticed your content over the last handful of months, last year, however long it's been, as it relates to operating multifamily assets. And to the listeners here, the reason that I wanted to have Moshe on the show is because operating multifamily is more critical now for multifamily investors to achieve successful outcomes when investing in multifamily than it has been in the last handful of years, where you could be an average operator and still do extremely well, given what was going on in the market. That is no longer the case. And our objective in this show is to talk about how investors can successfully operate multifamily properties. But with that being said, why don't we start with your story, Moshe, and you can share how you got into this business, what you're up to now, and talk about what you're working on with Sage Ventures and anything else that you have on your plate.
Yeah, excited to be here. When the market is strong, it's easy to win and everyone can win. And when the market is softer, it's tougher and it kind of weeds out the strong and efficient operators versus the less strong and less efficient. We'll leave it at that. I joined Sage Ventures in 2018. We're based in Baltimore. Our core business is buying and managing apartment communities in the Mid-Atlantic. We're owner-operators. We don't do any third-party. We do have a construction division. We've done a handful of residential developments, townhome communities, condo projects, even some single-family. We are doing our first project where those two divisions are coming together. We bought a building that was originally intended to be office. We converted it to warehouse. Sorry, not warehouse. We converted it to self-storage. And we are developing a ground up lease up on the land that was next to it. So first phase is 288 units. We had our first move-ins in May, and in about a month, we'll hit 6 months and we should pass 50% occupancy.
Love it.
So I came in, the company was growing. It was at 1,800 units. I came in as the director of leasing and marketing. I didn't have experience in multifamily previously. Before that, I was on the commercial real estate side, leasing office and warehouse side, worked for a vendor for a little bit and had some multifamily clients. So that became like my intro into multifamily. I never thought I'd be in multifamily, got here, and I've become obsessed. There's so many nuances to this business. I think there's a lot of copycat operators. You have these folks who kind of learn one model, then they go and they have some success with it. They go and they teach people, and there's a lot of replication. And I think there's just certain fundamentals that a lot of people don't look at or don't get. There's so many nuances to this business, and I'm curious, and I've become obsessed and extremely hungry to learn and get better. And I've been on a roll learning and getting better. I'm very grateful and thankful for my position at Sage. We're now at 4,300 units and growing. And I've advanced my position now as VP of Branding and Strategic Initiatives. So I focus on certain initiatives to help take our company to become more efficient and take us to the next level.
Love it. And to give the folks listening some context, so obviously 4,300 units, massive portfolio, very sizable operation. What class of properties are you typically operating? You know, what in terms of what you're working on, maybe size as well as, you know, new builds, you guys buy existing builds, you know, in terms of understanding where exactly you're fitting into the overall ecosystem?
I think that question is actually really important, not just for the context, but I think a lot of mistakes that are made is everybody just groups this industry as one big industry. And there's a lot of nuances where you have new development, you have Class A, the majority of the market is Class B and C stuff, just because there's more product. It's been around longer. You have student housing, there's senior housing. So all of our stuff is market rate. When I started, we did have some older stuff and some lower end stuff. We've sold off most of that. And so we've been buying Class A properties, and we'll call them Class B minus, some of our value add stuff. We still do some of that, not in the city, in the outer submarkets. Size wise, our average is like 400 units or so. So we've been buying bigger properties. It's more efficient for us to operate that versus smaller.
Yeah. So we're talking institutional real estate, right? This is not sub-institutional where you guys are buying from mom and pop owners. I would assume the vast majority of your deals are buying from other quote unquote sophisticated investors, sophisticated operators, but you guys are excellent at what you do. You can create some value above and beyond maybe where some other folks can, and take this much more nuanced and driven approach to operations. So my goal being set the stage for the listeners in terms of what exactly we're talking about here. And obviously you're focused on the institutional side. So maybe this is a question that you have an answer to, or maybe it's not one that actually makes sense given the fact that you've been on the institutional side of the business for the length of time you've been in multifamily. But I think it's a good place to start is to talk about where the operators of institutional assets, large properties, multiple hundreds of units in size, 20, 30, $40 million in value. What are some things that the operators of those types of assets do or focus on or excel at that maybe the operators of sub-institutional real estate don't excel at or don't focus on, in terms of differences between the two approaches that maybe you see in the multifamily sector?
I find that when you become a certain size, it becomes harder to pay attention to the details as well. Mm-hmm. There's probably an advantage with larger companies. I don't know how well they're executing on this, but they have a tremendous amount of buying power. On one of your lower expenses, marketing is one of your lower expenses. They do have an advantage. Apartments.com is going to give you a better rate when you have a larger portfolio than a smaller portfolio. you should be using this for your purchasing in terms of service certain vendors, contractors, suppliers that you can work with wherever your properties are. You should be getting better rates when you're larger and you're giving them more business. Are they all executing on that? I don't know, but they should be getting that. So there's a certain buying power that larger companies have. Some of these larger companies have large, well, first of all, I don't know the numbers, and people kind of think of commercial real estate and multifamily and being very large. The majority of the market is not institutional money.
Mm-hmm.
It's a very small percentage. The majority of it is, I mean, I guess when we say what is institutional, I'm thinking of like these pension funds or insurance companies or REITs. There is a lot of private money, a lot of private investors. You know, you look at the top 50, NMHC has the top 50 owners in the country. I think you have to apply to be on there, but it's just a count of your units. So I'm sure there's people who don't actually, that have more that are not on there, but it's a small percentage of the entire market, the entire industry. There's a lot of smaller companies like our companies between 3,000 and 15,000 units that are operating, that are not institutional. So the institutions don't run the market. But in terms of advantages, so some of their money is happy with lower returns. So they have the ability to buy at rate. Usually when you're a smaller company and you have family and friends that are investing and you're trying to give them this good return, so you're telling them 10%, or you're aiming 9, 10%, 11%, whatever it might be, something above the S&P. And some of these larger institutions have an advantage where the money that they have doesn't need that high of a return.
Yeah, for sure. No, and without a doubt, I mean, it's an entirely different dynamic from a deal making standpoint when you're talking a 50 unit building versus a 500 unit building, right? It's the capital that's financing and investing in both of those opportunities tends to be different. Just speaking very broadly, outside of maybe an individual investor buying a very large property that's doing some kind of a syndication and still bringing in retail investors and stuff like that, which is similar to how folks put together 50 unit deals. But in general, the operation of those two communities is different in a lot of ways, right? You have on-site staff in one, you probably don't in the other. You probably have, if you're working with a third-party company, you're working with a different caliber of third-party company on a 500-unit asset than you are on a 50-unit property, which is probably more of a local property management company that's got a different structure and has a different approach. And I think I'll try and define this question into one specific segment of operating multifamily, which is leasing, something that, and at least in our business, right, we are sub-institutional operators of real estate. We own and operate a lot of 20 to 80 unit properties. We have our teams in-house, and our real big focus right now is leasing and renewing current tenants, right? We want to make sure that we are leasing units quickly, efficiently, for the right price. We're not trying to, we're not asking too much in rent and then accepting too much vacancy as a result. Trying to use tech to leverage that or to better dial in that process. And I see, and it's funny because I'll get to a question in a sec. For me, I live in a big apartment building in Boston, right? 250 some odd units, an institutional type of asset, right? And I go through the leasing process as a tenant when I move into a building like this, and it's very different than the process for moving into a 30 unit building in a smaller market outside of like a Boston. Now, I guess to specifically ask you, what are some of the key components of maybe the leasing process for the assets that Sage owns and operate, that you oversee, in terms of what do you guys really focus on, really try and do well? And I think just by virtue of discussing that, it'll probably find some contrast to how owners and operators of smaller properties that are less dialed into that process approach that components of operating multifamily.
So when I started, my approach was very hands-on. We were smaller. I would spend a lot of time on site. And I think that larger companies struggle with this. There's a big disconnect between corporate and on-site. So I found there was a lot of value of spending on site. There's things that you see by experiencing that you don't see in numbers, that you don't see in reports, and that you can only experience by being on site. So I spend a fair amount of site, and there's a big part of leasing, let's just call it, it's a sales job. If you're really good at sales, this is not the career for you. Like, go sell something that you'll make a lot of money. Go sell property. I think leasing is the gateway for a property management career, and it's a great career. The overall, I mean, I believe sales is part of any job, but I see that. So my approach was, we started hiring people. I wanted to hire people with no experience. So we have a pay range. And I have this theory of change that you could either do it within the system or from without the system. It's a lot easier to make change from within the system. So if we have this, so I come in and we have a pay range that we're going to pay leasing in a commission structure. So if I want to come in and propose something very different, that's outside of the framework. Very difficult for people to digest that, come along with that, be willing to test it. So I wanted to see, what can I do within the framework? So first, we created certain reporting so we could have a good sense of what was going on within the framework. Then I wanted to hire folks in the framework that had no experience. And my thought process was, if I hired people with no experience and I could train them, first, I feel like I could train them better if they didn't have experience than if they already had bad experience. Also, that they would come in on the lower end and there would be a bigger runway for them to grow and develop with us. So if I hire someone who has 4 years of leasing experience, they're going to be on the top of that pay range. Within a shorter amount of time, they're going to want to make more money or be promoted. And if they're not, they're going to become resentful and disgruntled. Plus, I'm not so impressed necessarily with the experience they had at a different management company. The bar is fairly low. And like we said, like, when the market's good, everybody can win and do well. Most people go into this industry because people at the end of the day need a place to live. During COVID, this asset class did pretty well. Retail struggled. Office is getting crushed. Industrial is doing well, and multifamily has done well. And the barrier to enter is lower than other asset classes, right? You could buy a single family home, then you could trade that for a duplex and a fourplex. There's a natural progression in this, that there's a lower barrier of entry. Now, and it makes sense. It's not for everybody to start in leasing and progress to assistant manager, property manager, regional manager, but that's a nice progression. I want a property manager, a regional manager who's a generalist that has good experience and could be decent at all of these things. So I like sports analogies. The West Coast offense. Bill Walsh took the San Francisco 49ers, I think it was in the 80s, the worst team in the league, and within 2 years, they became fantastic. And they won the Super Bowl, I think. And he took an average player with a great system and made them really good. So I think the first part of leasing is having a good system. When I started, we had a terrible system for setting rents, for changing rents, for forecasting. And I don't know what others are doing, but I think I'll just assume that a lot have made some of the same mistakes that we made as we grew, and they have a really, really bad system for that. So I think that it starts with a really good system and a clear plan and understanding. And I think that the mistake that a lot of folks make with their system, it comes from their underwriting. And their underwriting comes from, hey, let's say you're buying a 300 unit, they renovated 5 units and they achieved X rent. So now you're in your underwriting and say, okay, we're going to come in and we're going to renovate more units and then we're going to get everybody up to this. And you're looking at it like on a T12 and you're changing the numbers over the whole year. And you don't calculate like how long does it take for that turn to happen. So my experience, I started in August 2018. If I get off track, just bring me back, eh? So I started in August 2018. We had just bought a townhome community and terribly mismanaged. Average rent was like $1,000, 400 units. Occupancy was like 80%. And we were renovating units and getting like $1,350. So I'd sit in these meetings and we'd be doing the renewals and say, hey, this person's paying $1,000. Let's give them a $200, $250 increase. And I was like, that's a lot of money for someone who's paying $1,000. And they're like, yeah, but it's great because if they leave, we're going to replace it with somebody paying $1,350. And I was like, how long is it going to take us to replace that? So we had this revolving door. We would push people out or people would not stay, but we couldn't grow our occupancy. So I was like, time out. Let's change our strategy. Let's keep these folks who are paying rent, even if their rent is way below what we're achieving, and let's hit 95%. Cash flow is great. So let's get up there, and then we could make these adjustments. And when we did that and we structured our system, and back then our system was to raise runs every quarter, we're adjusting rents. Now, many folks will use, and this is back to your question about institutions, better or worse, a lot of institutions are using LRO or YieldStar. They're using some automated system that they plug in a number and set it. There's a lot of power to these platforms, but I think there's downside where people stop thinking and they just rely on the machine to do the work for them. And I think that is a disadvantage. So we don't do that. We do have a system. We're changing rents weekly. And that was a big game changer for us when we created that system. So now we bring in people. We created a training program. Now, a lot of the property managers did not like hiring folks with no experience. So over time, we had someone within our team that advanced. We created a new position, a regional leasing manager. Now, when we hired someone, he would spend a week with them on site, and now property managers became a lot more comfortable with that idea, and it's worked really well. So the two rules of leasing is show up and don't stink, right? So how you look, how you present yourself, you got to show up. How do you show up? Are you excited to be there? How do you sound on the phone? Someone who is calling in the subconscious, all renters are looking for the same thing, a place they're going to enjoy. And how do they decide that they're going to enjoy it? Is if they determine that you care. If there's going to be a problem, are you going to take care of it? And so if you don't take care of yourself, or you're not excited to be there, what does that tell them in their subconscious? Now you have leasing, the bar is low. Why? Because people need a place to live. So this leasing agent stunk and the other one stunk. So at the end of the day, they're going to lease somewhere. So you got to show up, and then don't stink. Don't be a salesy person. You got to put their best interest, not yours. And they sense that. And smell, you can't ignore. You smell something and you decide if you like it or not. And same thing with sales. You do something, someone smells it, they're deciding if they like it or not. So those are the two rules. Obviously, you can unpack those a lot more, but show up and don't stink.
Mm-hmm. Let me hop in. So personnel, is obviously matters, right? The leasing personnel that's actually doing the blocking and the tackling of showing the units, as you just described. You also spent some time there talking about platforms that large institutions use to, dynamic pricing for units, and you mentioned how a lot of these larger owners and operators are more relying on the tech now, maybe not on actually getting in there and thinking on a more personal level and actually getting into the weeds. How do you go about setting rents? Like, what does that process look like within the organization as it relates to, you mentioned that you guys do this very frequently, almost weekly, right? In terms of setting rents and determining what units should be leased at. Is it as simple as we have data, we rely on our own data? Are we going out into the marketplace on a weekly basis and looking at comps? Is there some other approach to that process? How do you guys actually tactically set the rents that you lease units at?
I'll give you the summary of it, but it's a lot easier when you have fewer unit types. So this property that I mentioned, where we have like 5 unit types, there's 2 different 1-bedrooms, there's 2 different 2-bedrooms, and then there's a 3-bedroom. So let's just say each unit type is its own group. And you take the unit that you feel is in the worst location in the community.
Mm-hmm.
And then, so you have interior amenities and exterior amenity. So exterior amenities are going to be the location in the community. How far away is it from the amenities? Is there better parking over there? Worse parking? How far it is from the trash? Whatever it might be, you come up. And you come up with a dollar amount. These things are kind of arbitrary, but you're just trying to create a layer of, like, almost like a heat map. Like, where's the best place to live and where's the not? And I see too many operators, just every unit type in A or unit 1 is all the same. And you want to create these barriers. Like, is it on the first floor? Is it on the second floor? Does it have a balcony? Not a balcony? Then you're going to have in-unit amenity. So a balcony, would be an in-unit amenity. Is it a renovated unit versus not a renovated? Does it have some sort of an accent wall or upgraded appliances? Whatever that might be. So then you're going to put like certain price points, small, and these could be $5, $10 increments. So let's say you have 20 one bedrooms, they're not all going to be the same price, right? You're going to have $5 for the upper floors. You're going to have $10 for the balcony. You're going to have, you're going to have all these slightly different variables. And you do that for each group. And so we look at our 30-day and our 60-day availability. So let's say in our 30-day availability, we have 4 units in a certain group. So to cover that 30-day availability, we need at least 1 a week. So on our weekly call, we'll look at it and say, we got 2, let's raise that group 1%, 2%, whatever we decide. And then, so we look at that weekly. Are we hitting the number of leases needed to cover the 30-day spread? If not, then should we lower it 1%, 2%, or even more, depending on the different variables? That make sense?
Yeah, absolutely. And I actually want to hop in because I think what you just described is you just mentioned that a lot of folks don't do this, but I really want to highlight that because especially, and this really applies to the listeners that are in the sub-institutional size space in terms of what they're buying and operating, whether it's 30, 50, 70 units, and you have your 3 unit types, you got your 1s, your 2s, and your 3s, or whatever it might be. And there's no nuance beyond the bedroom count and maybe the square footage, but probably not getting into the level of diligence as it relates to how far you have to walk from the parking area. I mean, that's like a simple one that matters, right? And I think oftentimes there's folks forget to put themselves in the prospective resident's shoes when they are driving into the property and they go and park and they walk over to the units. How far do they have to walk? What does the curb appeal like on that specific area of the property? Is it all the way in the back of the property where they look out their window and they're just looking into a dark tree line and they have absolutely no view and it kind of feels a little, maybe not unsafe, but it's not as desirable of a section of the property as being by the front and by the road where you maybe have a view, there's more lighting, it's a little bit more attractive. Like all of this stuff matters. And oftentimes we just throw flat dollar amounts on different units and off we go from a leasing standpoint. So I think that was I wanted to highlight that as a really important takeaway. And so I have a follow-up question because I'm interested in the data that you leverage as well. So, in our business, and again, different level than where you guys are playing, but when we list the unit, we do all of the work to account for the nuance of finishes in the unit, amenities, location, floor, et cetera. And then we look at the interest that we get, whether it's just viewings of the listing, actual viewings of the apartment, applications, et cetera, to determine, okay, maybe we price that one a little low, or maybe we price this a little high because we didn't get as much interest as we'd like. And then we start to course correct. What does that look like for you guys? Is that something that you regularly utilize as data post listing a unit? And is that something that you then take back and then apply when you set the rent for other units in that complex or the portfolio? I guess maybe talk about how data factors into the decision-making process.
So there's a few things, and I hope I didn't miss something on the question there, but there's some parts of this business you're just never going to know the answer, and you have to be okay with that. And then there's some things where you could know the answer. So let me give you an example. We had a property that had 2 studios, and these were true studios. They weren't like a bedroom with no window. There was no bedroom. The whole thing is just wide open. And there was someone who lived in each of them were occupied for a while, and then they came back on the market. And then it sat for a while, and you're trying to figure out, where's the value? What do people like, not like? This was such an anomaly that you just need to lease it. Sometimes you might find someone who at that moment falls in love with it and is willing to pay more, and sometimes not. Now, when you have groups, so same type of thing, like when you're selling a physical product, you're selling a phone or something like that, you're trying to figure out a price point and then spend your marketing and how many of these you sell. Apartments are not the same. There's a time where people are willing to pay more. Sometimes they're willing to pay less. And if you're spending too much time trying to figure out those details, you're losing money. Vacancy loss is one of your biggest expenses. And so you're trying to get it perfect. That comes back to strategy. Like, you're not going to get it perfect. And if you are, like, great, you lost a lot of money by the time you figured that out. And by the time you figured out, the market has changed anyways. So, don't do that. So one of the changes that we made, so I got a little frustrated with certain things that we were doing. And I wasn't seeing eye to eye. And so I decided to highlight a new pain point. So on my weekly report, I would have the occupancy for each property, the 4-week trend, 8-week trend, and then I added a column for the number of units that were vacant 30 plus days. So at the beginning of 2022, I think I started this. And at the time we were like 3,500 units and we had 87 units. By the second week, somebody high up was not happy about this, right? Why do we have so many units that we're sitting on for so long? And it wasn't vacant units, it was vacant 30 plus. Mm-hmm. And so we made an adjustment. And then literally you would see over time that number would slowly and sometimes quickly go down. Overall revenue and occupancy went up. And that became like a point. So now I would like to cut that down. Instead of 30 plus days, let's start looking at it at 21 plus days. I think a lot of people don't track the average day vacant per unit. And I think that is a critical number. When you're doing your renewals and you say, hey, I hate market rent. Market rent is an artificial number. I could raise my market rents 10% today. It doesn't mean anybody's willing to pay that. So you really should be looking at achieved rents when you're doing your renewals. But let's just say you're doing what everybody else is doing and you're looking at your market rent. When you do that, so, and then let's say in place, the current resident is $200, $250 below market. Now, when you're trying to figure out what you want to do with them, you need to know the cost to turn that unit and your average number of days that it sits vacant. That is part of the formula. Too many people, and I think are getting bit in the rear end because of this, chasing these high values and greedy high rents. I'm not an expert at this, but what I've seen, when you maintain higher occupancy, you have less turnover, you have lower vacancy loss, you have less concessions, you have less turn costs, you actually grow your rents more. Because, and I learned this when we had that property that we bought, and when you have 50 units that you're trying to rent at $1,350, it's a lot harder to rent 50 of them than to rent 5 of them at $1,350. So when you get your occupancy up to 95, it's a lot easier to get those 5 to do that than to get 50 at one time. So when you have good retention and you maintain higher occupancy, it's easier to get those higher rents when you just have to get a few of them versus when you have to get the whole building or a good chunk.
Mm-hmm. Yeah. And, I think it's interesting because it's even more than the last couple of years. It's the last 4 or 5 years, really, with how quickly rents have been growing, but really from 2020 to 2022, where 10 to 15% rent growth each year, there was very little downside to turning units because it was really hard to organically renew tenants at a rate from an increase standpoint that kept up with what the market was doing. And the lease tradeouts were so significant as it relates to the incremental increase in the rent for that unit that a lot of owners were like, it's going to cost me to turn that unit, and it's going to sit vacant, but I'm going to get another $300 and then I apply it to my historically low cap rate and it makes a ton of sense. So that's fine. If somebody leaves, that's okay. And it seems like maybe that was a similar approach that Sage had at a point in time where let's take these units that are 1,000 up to the 1,350 and maybe we organically push to 250. If they leave, whatever, we'll get them to 1,350. But now it's not that case where rents are either flatlining or growing very minimally or sometimes declining in some markets throughout the country. You absolutely must prioritize your renewals. It's critical to maintain occupancy because if you are turning units and you're investing all of this money in CapEx to turn your units and they're sitting vacant, it's very, very hard to maintain a profitable building when that's happening at reasonable scale, right? If that's happening in any meaningful way at a property. So under that same umbrella, from a conversational topic standpoint, we really care about renewals. It's something we care about more than we ever have. We did fall into the trap, as many folks did, of it's okay if they leave because we'll renovate and lease at a higher rate. We were less concerned with renewals previously. Now we're really concerned with renewals. How do you guys prioritize and drive renewals? Do you have a system or a process when a tenant's lease is coming due and it's time to talk about renewals? How do you create a situation where you increase that renewal rate to as high as you possibly can?
So before I answer that question, just to go back for a second, REITs are public companies and you can look at their financial statements and their reporting. And it's interesting, I've combed through a handful of them and it seems that most of the REITs have this philosophy of maintaining higher occupancy. Now they are chasing higher rents, so I think that they do give concessions and they don't like to lower their rents usually. they do what they can to maintain those rents, but I'm guessing they're less conservative on the renewals and maintain their occupancy. Now, that's just speculation, but we were talking about institutions versus smaller operators before. So just a note that I have thought of. Now, when it comes to our renewals, we have somebody internal that's really savvy with Power BI, and we've been building out all these systems and tools. And we first have a scoring system. So we have a scoring system based on payment history. So we score residents based on payments, late payments, have they ever had a balance, things like that. So that carries a lot of weight when it comes to renewals. Who is the top tier in terms of that, the resident score. We'll just leave it at that. And then we group them based on where they fall in terms of relation to market rent. And I think we're starting to get a little more sophisticated with unit types and lease expirations. So we have an expiration curve. So in most markets, you definitely have busier seasons and lighter seasons. In most markets, it's the spring, summer, which is the busier season, fall, winter, slower. So you want to have your leasing curve to have more expirations when there's more demand, and you want to have less expirations when there's less demand. Now, in markets apparently like Arizona, we have a lot of people going there to retire. Apparently, like it's totally the flip. Like the winter time is like busy season. That's what I've heard. But anyway, so you have your leasing curve. So we look at that. So certain properties where, let's say 3 bedrooms, you really want to have in a certain part of the leasing curve. So if it's like the winter and we're looking at 3 bedrooms, or the renewal strategy would be like, we want to move that. We don't want that to become available in this time. We want to move that. So we're going to do a renewal and we're going to move their expiration to the springtime. So we'll break it up in certain tiers. We don't want to be too aggressive on too large of a percentage of our renewals in one given month. So we have like this system of what percentage where we'll be a little more aggressive and less aggressive.
Mm-hmm. No, that makes a lot of sense. I mean, we're both in parts of the country where the winters get cold and nobody wants to move in the winter. Every time we take a unit out to the market and we go out there to secure a tenant, anytime in November, December, January, we're typically offering 12-month leases, 16-month leases, and 18-month leases, right? Or depending on the month, we'll determine pricing that ideally motivates individuals to sign a longer lease so that their renewal comes due in May, June, July, August. And again, not something that a lot of folks do. It's kind of a lot of folks, they just assume 12-month lease. That's what they take it out at. They're just constantly signing 12-month leases regardless of the time of year it is. But it's a light lift to get folks on a better cycle, and it makes a massive difference. And at least up in New England where we are, the change in demand when you're leasing units in October, November versus May, June, July is entirely different. It's not like, we get maybe 5 to 10% less showings or 5 to 10% less in rent. It is a very, very significant difference in the length of time it takes to lease units, to the point to where we do everything we can to get off that cycle. And again, that's probably more of a dynamic in New England or the Northeast than it is, as you mentioned, in the Southwest or Southeast, where weather doesn't impact your ability to move as much. But I think that's a great note for sure. So, the last item that I want to talk about here before we get you out of here on time is how has leasing changed in 2023 or in the last 12 months? How is your approach to, and I keep using leasing, but how is your approach to leasing? Or if there's another topic that you want to discuss under the umbrella of multifamily operations that's outside of leasing, by all means, dive into it. But changes in systems, processes, approach as it relates to the fact that we are in a different real estate market. And again, I think there's just a different emphasis on operations than there has been. What are some things that have changed internally within Sage in the last year for you guys, whether it's leasing or some other segment of multifamily operations?
So I see people talking about how leasing has changed dramatically. I don't think it's changed much. There's a big movement to self-guided tours and automation. I think what drives that mostly is actually the REITs and these big institutions that want to cut expenses. When you have a brand new property and you cut in the people of self-guided tours, it's really easy to do it that way. Is it better? I don't know, but it's less expensive. And if it works for them, great. Is that what most prospects want? I don't think so. But I'm not clueless. And when you have, like you're talking about, smaller properties, you can't have a person at each property. So having a system and whatever you want to call it, centralized, self-guided tours, there's really a place for that. But I don't think that that's, we'll call mainstream. I don't think that's what actual prospects, for the most part, want. Is there a place for it? Yes. Is that the future? My opinion is no. So we bought a property from a big owner, a top 50, in December 2020. And we opened up the leasing office, and I was there helping to lease. And people were surprised. They're like, "Oh, you actually conduct tours? Thank you. Like, I'm sick of this self-guided stuff." We bought another one, and they had self-guided as the option. The other one, that was the only thing. And they ask everybody, and it was literally 9 out of 10 preferred the in-person. When I go look at properties, I prefer the person. I could ask them questions. It's a better experience. I get to know it, what it's like. It's not like ordering on Amazon to find an apartment. So I don't think that the fundamentals of leasing have changed. I think the same rules, the same science: show up, don't stink, be friendly, don't be pushy, understand what it is that they want, know how to control the conversation without being controlling. I don't think that has changed. People talk about, like, prospects are so informed now and everything. Like, we've been online for a little while now. It's there. I don't know the exact data, but I would pretty confident if you call most property management softwares, are never going to tell you this, or operators, their number one source of leads is phone calls. Why? Everything they could see is online. They could book it online. That, for most places, you could book a tour. You could do this automated thing. Why do they call? My theory is that subconsciously they want to know if they're going to enjoy it. You're going to get a better sense of a community by talking to a person there versus just doing it automated. That's my theory. So I don't think that leasing has changed so much. I think, going back to the strategy part, I think that a while ago, people should have been much better at their renewal strategy and even their initial leasing strategy, in terms of, listen, you're investing money and you want to get a return on it. When you renew somebody, you know what that costs you? It costs nothing. Zero expense, and you just bumped to 3%, 4%. That's a great return on $0.
Yeah.
When you do these full renos, someone just sent me this deal they're looking at. They're talking about $17,000 a unit. And I was actually looking at that market, and I was like, the rents have been growing without the renovations. So why are you spending all this money to get it to $200, bump it $25 with putting zero into it? And then there's certain renovations where people do that just don't enhance the quality of their life. That's just what everybody else is doing, right? I think that there's room, and if there's no price difference, there's price difference. But whatever, if you have tiers and appliances, like the black ones versus stainless steels, there's a lot of demographics that don't care that much about it. They want a new one. They want one that works, but don't pay more for the stainless steel or the backsplash. Improves quality of life a lot more. Recess lighting. Nobody puts in recess lighting. You know what that costs? $100 a light. You put in 6, right? That costs you $600. You could bump the rent $25. That's a much better return than $10,000 and renovating the whole kitchen and bumping it $125.
No, I mean, it's great points. And it's interesting because it is contrarian. I shouldn't say contrarian, but it's just different than the common discourse. Yeah, which I agree with, and that's in our business now, where I'm cool just renewing at, even without increases. Like, I care much more about occupancy now than I ever have in our business. I would rather be at, 95, 97 with rents that are slightly below what we would define as the market rent, or what we think we could lease it at if the tenant vacated and we found a new resident, than, 90% with an absolute maximized rent roll. And I think it's just different than what everybody's talked about over the last 3-4 years, where it's all about set the new rent comp within your building. That's how you maximize the value. That's how you hit those big capital events. You hit those big refis. You hammer the appraisal. When you go and you market it to the next buyer and they see that they can get whatever it is, $2,000 for that 2-bed unit. And then they have the whole vision of, okay, I'm going to go turn over all the other ones. It's just the business isn't that anymore from an operations standpoint. It's just a different business. So I totally agree with you, right? Why would you put $17,000 of capital at risk and take on all that execution risk to pick up another couple $100 a month if you can just organically renew the classic style at another 25 or 50. I mean, when you actually sit down and do the math,
Well, I'll tell you why they do it.
makes a lot of sense. Yeah.
Because they're the construction company also.
It's also true.
So they have their investors that are buying the deal. They're making a fee on being the sponsor. They're making a management fee, and then they're making money on construction. And the property doesn't even have to cash flow. And they're making a ton of money. There are people posting on LinkedIn about their deals, and they're doing a ton of marketing and attracting all these investors, and they're not performing. They have properties in the red. They're buying deals like this, like that I just looked at that didn't make sense. You're putting in all this renovation. They're talking about cash flow return, annual returns of 6%. Like you could get that in a treasury and there's no risk and it's liquid. Why are people renovating right now? I have no idea. The market is going down. So you're pumping in these things to get rents. Like it just, people need to do a better job of their due diligence and just be more educated. And the reporting is very, a lot of them are hedging like some of their successes and their track record. But it amazes me how many don't talk about the returns on their deal. They talk about ones and twos, but like how many have stopped distributions, just certain things. There's shady stuff going on. And it amazes me. It's sad that there's so many people who just invest based on marketing and they don't know the people, and it's not so good. But yeah, people need to know. They need to know operators things. What has always worked or has worked well in a great market is not going to work now.
Yep. I think it's a great closing comment. And before we get you out of here, why don't you share where folks can learn more about you, learn more about what you got going on, Sage, anything you want to plug?
I'm active on LinkedIn. I've been posting a lot of like data kind of stuff. I've been looking at a lot of stats. I'm super intrigued. I'll tell you, you have to be hungry. Two stories that really lit a fire under me is Moneyball and The Big Short. So Moneyball is a story of the baseball team, how they perceived value. They saw it as buying wins. So the more people would get on base, the more runs they would score, the higher probability of winning. You got to think of that. You're buying cash flow. Don't buy value, buy cash flow. So you have higher occupancy. These are your values. You're going to have lower vacancy loss. You're going to have lower concession. That's value versus, oh, let me pay a lot of money to create this value. So yes, eventually you'll have a higher value property with these higher rents, but you're not always trying to refinance, especially in this market. You're not always trying to sell. So if your whole model is always adding value and you're sacrificing cash flow, it's not a good model. Second was The Big Short, where it tracks these four firms who made a killing on the financial crisis in 2008 because they saw these indicators. And when I listened to that story, it blew my mind. And I thought, how could this happen again? How could this happen in multifamily? And the truth is, I think it's the bank's fault. You know, there's four companies that are responsible for servicing these loans. What do they do? Like, we barely report to them. Maybe it's yearly. We're supposed to report if there's an issue, but they're approving these loans, right? They're improving these these performers that are based on high renovations. Who's looking at delinquency? I think there's a major delinquency problem in this country, and nobody has the data for that. There are companies that do; they don't share it, right? These property management softwares, Yardi, Entrata, RealPage.
They have all that info, which is interesting to think about. Yeah.
Wouldn't you like to know what the delinquency is in a market that you go buy a property in?
It'd be huge. It'd be probably one of the most critical pieces of data you can have because it's what most people get most incorrect. They forget that there's economic vacancy. Who would have thought? Yeah.
I think that should be your value add, is improving collections. We bought a property, that one that I mentioned in 2020. And I remember showing it to somebody and he's like, why do you guys like this deal? And there was a lot of fraud. There was so much bad debt. It wasn't a value add deal for us. It was built in 2013. And that has, I think, returned the best returns for us because we just made it more efficient and we removed all the bad residents. Collections is fantastic now.
Mm-hmm. I love it. No, that's great.
So you can find me. You can find me on LinkedIn. I post a lot. I'm pretty active, sharing my thoughts. I'm learning. I'm in progress. Like I'm not this expert. It's just I'm sharing what I'm learning. I'm obsessed with it. It's so interesting to me. I do also have a podcast, The Curious Wire. You can find it on Spotify. And reach out. I love talking about this stuff.
Absolutely. I'll be sure to link it all in the show notes. And thanks again for taking the time. This was it's a fun chat because it's topical, and I think a lot of folks are going to enjoy it. So thanks for taking the time to come on.
My pleasure.